Hi guys, welcome back to another video. My name is Josh, and in this video we'll be talking about Oceania Healthcare. I'll be doing an in-depth stock analysis. The stock is NZX, listed on the New Zealand exchange as well as listed on the Australian exchange as ASX OCA. So Oceania Healthcare is the largest position that I have in my private as well as public portfolio that I talk about on this channel. And across those two different accounts, I do have roughly 20% of my portfolio in Oceania Healthcare. So that is quite a large position for me personally, which is why I dedicate so much time and energy into researching the stock. So hopefully you appreciate this video as I go into in-depth into Oceania's business. And as always, this is not financial advice, purely for entertainment purposes only. You can read the full disclaimer down below. Without further ado, let's get right into it. So the current share price for Oceania Healthcare is $1.30 New Zealand dollars, and year to date they are down 1.52%. However, if you look at their price performance since they IPO'd in 2017, the share price is up 51%. Or 64.56%. So Oceania Healthcare operates in the New Zealand residential aged care and retirement village sectors and is the leading provider of premium healthcare services in New Zealand. And as they say on their website, they build villages, not just homes. They operate in 44 different locations across New Zealand, and the location in which they have the largest number of villages is in Auckland, which is expected to have the largest density of retirement villages. Oceania Healthcare provides 4 different product offerings, from care beds to care suites, apartments, and villas. So now let me take you on a virtual tour and to show you guys what these different product offerings look like. So the first one we have here is the care beds. Now this is typically a private space and it's quite a small room, and the cost of the standard room is funded by the government unless you do decide to go for a premium room, in which you will have to pay the extra amount to cover the premium features. So the premium features could be more space, an ensuite bathroom, or outdoor access. So next we have the care suites. The care suites provide both rest home and hospital level care, and they charge you a weekly fee as well, similar to the care beds. When you move into a care suite, you essentially have to acquire what they call an occupation rights agreement, which usually is a lump sum cost. This will allow you to have the right to stay in one of these units. Oceania makes money by charging a deferred management fee, and I'll go into a bit more detail when we talk about the business model. Next up we have apartments. Now this is an apartment from the Sands, which is their most premium location. The same fees apply to apartments as with care suites. You will get charged a weekly fee as well as a deferred management fee. And lastly, we have the villas. Now villas are more about independent living, and the same fees apply. You have weekly fees and deferred management fees. If you want more details about each of these types of different units, you can check out their website. Next up, let's talk about the industry. So the charts that I got from this part of the video is from the JLL research white paper. If you want to know more detail about that, be sure to check that out. The first thing is that the over 75 years population is expected to increase from over 300,000 in 2019 to just under 800,000 in 2043, right? So that is more than a 2x increase in the next 24 years. What this means is that there's going to be a huge demand for retirement villages, and therefore this provides a good tailwind for the business to grow in the future. So as we can see here, the forecasted unit demand is currently sitting at just over 50,000 by 2028. Currently, we have roughly 35,000 units. And this number of roughly 6,000 units have been commenced by the current retirement village operators, and there's still roughly 10,000 units that need to be built in order to meet the forecasted demand for 2028. So basically what this tells us is that there won't be any shortage in demand for the next few years. This chart shows us the market share of each retirement village operator in terms of the market share of retirement villages as well as the total units across New Zealand. As we can see here, the top 3 biggest retirement village operators have a higher number of units relative to their retirement villages, whereas the smaller providers such as Bupa and Oceania have a higher number of retirement villages but a smaller number of units. So what this tells us is that Bupa and Oceania are more focused on their care offerings. Next, let's take a look at the business model. So this is how Oceania makes money. Firstly, they do charge weekly fees, as I talked about earlier. They charge the village and care fee. Secondly, they make development margin. Essentially what this is when Oceania builds a unit and sells it for a higher price than what it cost them, they make the development margin. So for example here, to build this unit, Oceania spent $800,000, but then they sold it for $1 million, essentially making a development margin of $200,000. And here we can see Oceania compared to its peers in terms of development margin, and Oceania has the highest development margin of 33%. And this basically reflects that Oceania has been selling more premium property, which commands a higher development margin compared to its peers. So Oceania also makes money from the deferred management fee of 30%, or essentially 10% for the first 3 years on an ORA, which is an occupation rights agreement. And they also make money from a resale gain. So I'll explain these two numbers using this chart below. So when a resident moves into a unit, they will have to pay for an ORA if they want to move into a care suite, an apartment, or a villa. So say for example, this resident lives in this unit for 7 years before moving out. What Oceania will do is that they'll amortize the ORA for 10% for the first 3 years and then 0 after the first 3 years. So Oceania will allocate $100,000 for the first year, another $100,000 in year 2, and another $100,000 in year 3, and anything beyond year 3 is recorded as 0. And what they'll do then is that they'll allocate that $300,000 across 7 years, which gives us an average DMF per annum of 42.8K. The resident essentially gets back $700,000 when they move out because Oceania has already taken $300,000 in deferred management fee. This is a really capital efficient business model because Oceania is able to take the $1 million that the resident pays them upfront when they move into the unit to reinvest in another project, which allows them to continue to build more units, essentially with an interest-free loan from the resident. And then say after 7 years, this unit is now worth 1.5 million and they sell that unit for 1.5 million. They'll make 500,000 in resale gain because initially they sold it for 1 million and now it's worth 1.5, making a resale gain or a capital gain of 500,000. Now this whole situation changes when the resident only stays in there for 4 years. So as you can see here, assuming the same thing, but instead of living for 7 years, they only live for 4 years in the unit, then the deferred management fee on average will be 75,000 across the 4 years. So essentially, the shorter the period, the more money they make in deferred management fee because they only record 10% for the first 3 years. And you might be wondering why there is a difference in terms of deferred management fee. Well, the reason being is that there's different average tenure periods for different types of units. So for independent units, Oceania estimates that the average tenure is roughly 7 years. For apartments, this is 5 years, and service units is roughly 3 years. So now that you understand this business model, let's talk about Oceania's business model going forward. And their plan is to shift their current portfolio, which is currently 44% weighted towards premium units and care beds, to be roughly 69% when it is fully developed. And remember, Oceania does not charge a deferred management fee on the pack beds and the standard beds. And you can see that this number is actually reduced from roughly 49% in FY 2020 to roughly 28% once their pipeline is fully developed, as well as that they're going to increase the level of premium villas and apartments, and that will incur a really high deferred management fee, and care suites as well from 17.7% to 26.9% when it is fully developed. And remember, care suites tend to have a pretty short tenure period of roughly 3 years so that they can start making a higher level of deferred management fee. And because Oceania's business is more aged care focused and more needs-based focused, this means that there will be less demand elasticity in the sense that this is a matter of need, not a matter of want. Now let's take a look at numbers and valuation. The numbers for Oceania Healthcare haven't been so stellar in the past few years. As you can see, EBITDA has been roughly flat. Underlying net profit after tax is down from 50.7 million in FY19 to roughly 42.9 million in FY20. And I'll touch on a little bit about this on the next slide. Operating cash flow has increased, which is good, from 89.3 million in 2019 to 99.4 million in FY20, and total assets have increased by 100 million in FY20. There's a few reasons why net profit is down. Due to the Rona level 4, people couldn't come and see the units. So what this means is that sales have been deferred into FY21. As well as that, there have been increased costs related to Rona, and the government didn't fully subsidize these costs. So that's why net profit has actually decreased in FY20. Do I see this as a concern? Not really, and here's why. Looking ahead into the first half of 21, we should expect an increase in new sales plus resales, because in the annual meeting, the CEO did mention that once the restrictions on sales have eased in alert level 2, we recommence sales activity and have recorded strong sales levels through June, July, and August, 26% higher than the same months last year. So essentially what this means is that sales have been shifted from FY20 into FY21, so we should expect a much higher sales and resales number for the first half of FY21. Furthermore, we should expect an increase in aged care earnings. From the FY20 annual report, it says that aged care earnings are accordingly now at a point of inflection and will grow as our strategy is further implemented over the coming years. So as I mentioned before, Oceania is in the process of converting their portfolio into a more care-based focused portfolio. And as part of this conversion, they did incur a lot of upfront cost into 5 of their most recent developments since the IPO in 2017. And what that means is that they front-loaded a lot of these costs to get these sites up and running. Now that these sites are up and running, they should see a much higher return on their current premium beds compared to the previous beds that they have replaced. Furthermore, we should expect a significant increase in property revaluation. From the FY20 annual report, we can see that the change in fair value of investment property was a negative 21.7 million in May 2020. Now, if you don't know already, Oceania Healthcare has a year-end date of 31st May 2020, and the properties were actually valued by the property valuers as at April 2020. April 2020 is when New Zealand was in level 4 lockdown, and the end of April 2020 was 1 week after the lockdown was lifted. So the valuers were being conservative in their assumptions, and as you know, property values have increased since lockdown. And you can see the numbers here. In May 2020, the house price index was actually up 7.9%. So 1 month after lockdown, we can see house prices increasing yet again. And since then, in October 2020, house price index was up 7.7% for 3 months. Okay, so this is basically for August, September, and October. Yet, Oceania recorded a loss on their fair value of investment property because of the valuers being conservative. If Oceania was able to make $46.6 million when the house price index nationwide was up 1.8%, how much more will they have actually made in May 2020 when using the actual house price figures? So I expect a significant property valuation going into the first half of FY21 to reflect that the loss on May 2020 wasn't actually a loss, but rather maybe a modest gain, as well as the huge gain since the Rona, since the lockdowns, and that should be reflected in first half of 2021. And just to further re-emphasize that house prices have inflated at the fastest level in 16 years. According to CoreLogic, house prices grew at their fastest level in 16 years in November. I can essentially see the NTA to increase by roughly 10 to 15 cents per share if I am being conservative here, okay? So next, let's take a look at how Oceania compares to its peers based on an earnings basis. Oceania has a similar price to earnings ratio compared to Arvida, but much lower than its peers like Ryman and Somerset. What's interesting to note is that I used the numbers based on Arvida's half-year report announced in September, which included obviously the few months after lockdown with the increased level of sales. So in terms of Oceania, if they had a balance date ending September 2020, I think they would have a much lower PE ratio compared to Arvida, which currently sits at roughly 18.68 times. Furthermore, on a price to NTA level, Oceania is still priced slightly above Arvida at 1.37 times. Going forward into FY21, I think Oceania will be the cheapest in terms of price to NTA. Valuation wise, Oceania currently has a market cap of roughly 800 million at a price of $1.30 per share on the 8th of December as of recording this video. So according to my estimates, I think Oceania can do 65 million of underlying net profit after tax in the next 12 months. Now I do specify 12 months because Oceania will change their balance date to the 31st of March 2020, which means there's only 10 months in the period. So if we prorata it, it will roughly be 54 million for 10 months. Okay, and my assumptions is that there will be an increase in new sales as well as resales, as the CEO has mentioned, 26% up compared to last year. In addition, there will be a removal of Rona costs of roughly 4 million that we had in FY20, so we wouldn't have that in 21. And further, there is going to be earnings growth of 10% as they convert more of their units into units that do charge the deferred management fee. So currently they do have a dividend policy of roughly 50% of underlying net profit after tax. So based on my forecast of 65 million, that would give us a dividend payout of roughly 32.5 million or a 4% yield. And this also puts Oceania at a forward PE of roughly 12.3 times, which I think is a really reasonable valuation relative to how much growth it has in front of them. Just want to caution you that this is just an estimation. This is not fact, obviously not financial advice. Now, let's talk about the risks involved with Oceania Healthcare. There was a CFFC, or otherwise known as the Commission for Financial Capability. They released a report on the retirement village industry as a whole, suggesting certain changes to improve the industry. So some of the changes that they recommended is to improve the sale and buyback process, including introducing a guaranteed time frame for buybacks, interest payable for vacant periods, and allocation of any capital gain on sale between the resident and the operator. Another recommendation that they made is to reduce the fees after the resident has moved out of the unit. They recommend that they reduce weekly fees by 50% after 3 months and to stop them entirely after 6 months. But what I noted that was quite interesting is that this change is proposed pending cost-benefit analysis to determine its impact on different types of retirement villages, particularly small and independent non-profit villages. So in the retirement and aged care industry, the profit comes from developing new units as well as charging the deferred management fee. The care side of the business isn't actually very profitable. So smaller, independent, and non-profit villages need to receive that level of revenue. Otherwise, they would probably be operating at a loss. These small and independent operators tend to be not very profitable because they don't develop new units. My gut feel is that small and independent non-profit villages won't be able to absorb this lower revenue. So this could also be good for larger operators like Oceania Healthcare, because what this means is that obviously as more smaller non-profit villages shut, there will be residents having to move into other places, and one of them is Oceania Healthcare. Another big key risk is wage costs. So at the moment, the retirement village industry is struggling because the wages that they pay to their nurses is actually slightly less than what DHBs are paying to their nurses. So this is a CEO's answer in terms of the entire situation on the sector. He says that the sector continues to lobby for increases in aged care funding so that higher pay rates can be provided to staff, and the sector has been specifically lobbying for funding to pay registered nurses at rates equivalent to their counterparts in the DHBs during this period. So essentially, the increase in wage costs will have to be government funded, or the remaining wage increase will be passed down to customers or the retirement operators just absorbing the costs and subsidizing it with their profits from development. So these are the key risks that I see with Oceania. I think the government probably wouldn't want to disrupt this industry because firstly, Oceania provides an essential service that the government isn't providing. They are providing aged care services. And secondly, Oceania and other retirement operators build a lot of houses, and what this does is that it relieves some of the pressure from the housing market. Now, if we look at their board of directors, I think this is a really stacked board of directors, okay? Elizabeth, she is the chair of ScalarUp and EBOS Group Limited, which are public companies as well. Alan Isaac is currently the president of the Institute of Directors New Zealand. And we also have this super famous Gregory Tomlinson. Now, this guy is the man, a really successful businessman. Oceania actually acquired his rest home in 2008. And since 2008, Greg has been a director of Oceania Healthcare. And he's also a director in our favorite bank that I cover on this channel, which is Heartland Bank. And I'll just show you how much shares he owns just a little bit later. Firstly, Elizabeth Coates owns 1.3 million shares in Oceania Healthcare. Do I think her interests are aligned with us? I would think so, because that is quite a decent number of shares. Now, Gregory Tomlinson. Look at the number of shares he owns, 16.3 million in Tomlinson Group Investment Limited. And he also has another vehicle called the Harrogate Trustee Limited vehicle, and that owns 3.6 million shares in Oceania Healthcare. So this guy is definitely a big dog in that he owns a lot of shares in Oceania Healthcare. And fun fact, this is how much Greg owns in terms of his Heartland Group Holdings Limited holdings. He owns 58.3 million shares. So, you know, this guy is a really successful businessman, and just look at the positions he holds. That really does show his confidence in the business going forward. Let's talk about the CEO for a moment. His name is Earl. Now, Earl has been with the company for a really long time, since this company listed, and you can see that he does own 2.1 million shares in his family trust. Okay, so I think this company has really good management team. You know, their interests are surely aligned with shareholders, and I think this company will do well in the long term. So to conclude this video, I think Oceania Healthcare is a company that has a lot of growth in the future due to the industry tailwinds, as well as their business model showing improvement over time. I think the company has been plagued with several short-term impacts, especially due to the timing of their balance date, as well as the impact of Rona on the business by incurring increased costs. I think a lot of the risks involved with this industry as a whole is slightly overrated. I think the government wouldn't interrupt with this industry because this industry does provide an essential service, as well as relieving some pressures on the housing market. And this makes Oceania a long-term hold for me. So this stock probably won't 2x in the next year or so. This is a stock that will grow over time. I think there's a lot of growth potential, and there is a surprise to the upside in my opinion. So let me know what you think about Oceania Healthcare. Let me know in the comment section down below. And if you do want to buy Oceania Healthcare, be sure to sign up with Sharesies. I do have a link down below. You get $5 when you sign up using that link. I get $5 when you sign up using that link. So this will help me continue what I'm doing on this channel. If you enjoyed today's video, be sure to hit like, as well as subscribe for more content to come. Thank you for watching, guys. Until next time, take care.